Champions Oncology just dropped their Q1 numbers, and honestly, they left a lot of investors scratching their heads. You see, they beat their profit targets, but the stock still took a hit. So what is really going on? Well, we're going to break down the quarter, unpack the market's reaction, and get into the huge strategic shift that explains all of it.
And right here, this is the heart of the confusion. On one side of the coin, you've got a profit of 2 cents per share. That's a solid beat, especially when everyone was bracing for a small loss. But then you flip it over and revenue came in at just $14 million, which was a miss. It's that classic mixed signal, a beat on the bottom line, but a miss on the top. So, how did the market vote on this news? Well, it voted down. Despite that earnings beat, the stock tumbled over 3% in pre-market trading. And that tells you everything you need to know. It says investors were looking right past that headline profit number and zeroing in on the weaknesses hiding underneath. Which brings us to the big question for this whole explainer. Why the disconnect? I mean, why would a company that beats on profit see its stock get punished? Well, the answer is a fascinating story of short-term pain for what management is betting will be some serious long-term gain. Okay, so to really understand what's happening, we have to deconstruct this quarter. We've got to pop the hood and look at the specific numbers that really spooked the market. And here it is. This is probably the biggest red flag of the report. Gross margin, the profitability of their core business, got squeezed hard. It fell from a healthy 50% a year ago all the way down to 43%. That is a huge hit to how much money they make on every single dollar of revenue. Now, on the earnings call, the CFO, David Miller, he gave a super specific reason for this. He pointed the finger directly at higher costs because they're outsourcing their radiolabeling work, which is a key part of what they do. So this wasn't some broad slowdown. It was a very targeted operational problem. And you can see on this slide how that one margin problem just cascaded right down the entire income statement. I mean, revenue was basically flat, but look at the damage to profit. Adjusted EBITDA was basically wiped out, falling from $2 million to just $60,000. And operating income, it swung from a nice profit to a $500,000 loss. The company's core engine was definitely sputtering. But this quarter was about so much more than just profitability pressure. This was the official kickoff of a massive strategic pivot, all being led by a brand new CEO who has a totally new vision for where this company's headed. Let's just look at the timeline here to get some perspective. Rob Brainin is named CEO in mid-July. That's right after the company announced a record year for revenue. So he comes in with a clear mandate for change, and boom, he immediately starts rolling out his new two-engine strategy in this very first quarter. So what on earth is this new strategy? Brainin is calling it the two-engine model. Think of it like this. Engine 1 is the old business, their core contract research services, the CRO stuff. The goal there? Just keep it stable. But Engine 2? That's the future. It's a brand new, super high-margin data licensing business that they plan to scale up and scale up aggressively. Now, what's so wild about this slide is it shows you just how early they are in this whole transformation. The old services business still accounts for pretty much everything, $13.7 million. That new data engine, it's just a tiny little sliver at $300,000. This is a huge bet on the future, not on where things are today. And you can hear it in the new CEO's own words from the call. He's not focused on last week. He said his focus is on sustainable long-term growth by chasing the large value opportunities in that new data business. He's basically looking investors in the eye and saying, look, I know this quarter is messy, trust my vision. Of course, building a brand new high-growth engine, well, that's not free. This whole pivot requires a lot of investment. And that brings us right back to the financial pressures we saw in the quarter. Both R&D and sales and marketing costs went up a lot. R&D was up something like 43% year over year, and management was really clear that these were very intentional investments. The R&D money is going to build out the data platform, and the sales and marketing money is to hire the people who can actually go out and sell it. And this all connects back to that gross margin problem we talked about. Management laid out a very clear 4-step plan to fix it. Right now, they're feeling the pain of outsourcing. Step 2 is they're investing in new infrastructure so they can eventually, step 3, bring that work back in-house. And the payoff, step 4, should be a big expansion of those gross margins down the road. So, the million-dollar question is, can they actually afford this big transition? And the balance sheet gives a pretty clear answer. Yes, they've got over $10 million in cash, they have zero debt, and this is really important, they still managed to generate positive operating cash flow. That gives them the runway they need to fund this whole strategy without having to go raise more money and dilute shareholders. Okay, so putting all of that together, what's our take? What are the key things that we're going to be watching for as we head toward the next earnings call in a few months? For us, it all comes down to execution. The potential catalysts are really clear. The street's going to want to see revenue start growing again quarter over quarter, proof that the margin recovery plan is working, and of course, announcements of some big new data license deals. The risks? Well, they're at the flip side of that coin. Failing to execute this pivot, customers being slow to adopt the data platform, or just a tough biotech environment in general. And because of that balance between risk and reward, our rating is market perform. This is the absolute definition of a show-me story. We're staying on the sidelines for now because, look, the upside is huge if this works, but the risks are very real. It's now on management to prove they can deliver on this vision. And that brings us to our outrageous but plausible trade idea. If you're a true believer in this pivot, the trade isn't just to buy the stock. It's to go long champions while at the same time shorting a basket of their old-school pure-play CRO competitors. What this trade really does is it expresses a powerful thesis that if this data platform works, Champions is going to get re-rated by Wall Street with higher software-like multiples, leaving all its traditional peers in the dust. So that's our take on the quarter. And as always, remember, this is not financial advice. Be sure to do your own research.